Great. I think we're going to get going. So just a warm welcome to all of you. I hope you had a great Easter. Thank you for joining us so shortly after your nice long weekend. Perhaps if I could ask you all to just mute your microphones. We definitely have someone's long weekend that we're hearing about. Not sure whose it is, but great. So thank you. Yes, a warm welcome to everyone. We're immediately going to get into presentation. Will equity markets bounce in 2024? This sort of adds to our theme of our last webinar, and there's quite a lot that's happened since then. So perhaps as an introduction, if you don't mind, and I'm going to get Tony's actually driving the slides, so I'm just going to ask him to move. So just a couple of updates on the MyPlan Global Macro Fund. So two things have happened since then on an award basis. Tony's picked up another award for Global Macro. This time it was actually Global Marathon, another fund that he runs, which gives him awards. And these are all 5-year awards, 2016, 17, 18, 19, 20, and 21. So I think that's unparalleled. In fact, I have had it confirmed from Profile Data that no fund has won an award every year for so many consecutive years. And then the other award that Tony won last year as well, or MyPlan won with the aid of Tony, as the Citywire Award for the best asset management in the mixed asset flexible sector. And I suppose that sort of sets the tone of Global Macro. But before we go there, just to announce that we have launched a US dollar version of Global Macro. It is available on 91 Momentum, and it will be shortly on Glacier, Capital International as well as Direct. The total fees of 0.85% are very similar to Global Macro in Rand terms, and I think that's very competitive, or probably one of the most competitive funds in the global space. So it's been running now since the 1st of March, and the performance has been excellent in both the dollar and the Global Macro Rand space. So how's it actually looked? And in its sector, since inception, you can see quite exceptional. The blue line, the Global Macro, and its sector average, which is give or take a bit of latitude, almost double what the sector has actually produced. I think that the next slide really does tell the story. So what we were trying to achieve in Global Macro, and through its mandate, because remember its mandate is very much to try and beat the equity markets, but with flexibility. So the benchmark is 80% MSCI, 15% short-term fixed interest, and 5% in South Africa for liquidity. So you can actually see against the general equity, and it has done exceptionally well versus the general equity index. So you've had equity type returns at lower volatility, and I think that's where the magic of this particular fund comes in, and that you don't want to be 100% in equity all the time. And Tony has really used that flexibility to the maximum. And I think going forward in the next 2 years, even the title of this presentation really goes to, we don't know what's going to happen in the equity markets this year. And that flexibility really will help Tony, and it allows him to bring to the fore all his asset allocation, his Global Macro skills, and his stock picking skills. So how's it looked on a relative basis? There you can see very much on a blues first quartile, green second quartile. You can see that performance, which has resulted in those awards, has actually continued. I think if we have a look at the Smarty Box, which really looks at calendar year performances, the fact that the fund has seen all these various cycles and has adapted through these cycles really is testimony to what Tony does. I mean, interesting if you just go and look, back in 2018, it was all about healthcare. 2019-20 was all about information technology. We'll all remember the 2021 and 22 about energy, and look where energy is in 2023. So if you don't have a flexible approach, if you can't rotate, and if you don't rotate, we've all seen what happens. The star performer in 1 year goes to the bottom of the pile in the next year. So I think that that really tees up this presentation, because we all really are thinking in our own minds as to what's happening in 2023. Where's the performance come from? How did it look compared to where we were before? And how has Tony managed to ensure that performance has been consistently in the top quartile? So Tony needs no introduction. Over to you, Tony.
Thanks, Tom. Morning, everyone, and hope you really had a good Easter weekend. Chatting to you from the metropolis of Paternoster. Delightful what this new technology can bring us. I am going to take you on a journey today, as I always tend to do, and I think the focus of investor concern at the moment is really understanding the macroeconomic environment. A lot of confusion, I think a lot of opportunity, and I think a lot of misfocus on where risk is and where risk isn't. So I'm going to try and unwrap the macro environment for you, and then really share with you how the macro environment is tied into the financial market response. For me, the signals are relatively clear. I'm finding the macroeconomic environment relatively easy to read, and hopefully by the end of today, you'll get a high level of comfort in dealing and chatting to your clients, that those same signals come through in your process of discussing markets with your clients. I'm representing the Smarty Box because if we have a look at what's performing in the top right-hand corner, consumer services, information technology, and consumer discretionary, that is not what was expected at the start of the year. What was expected at the start of the year was quite a different picture. I remember someone sent me the Wall Street Journal of the 5th of January. 500 strategists had dug deeply into what they expected for 2023, and the basic outline of what the consensus was at the time was we were going to have a recession in the US, inflation would fall strongly, the Fed would pivot, we were going to have a collapse in earnings. Merrill Lynch was predicting 3,300 on the S&P, and it was very, very gloomy, very bearish. I took quite the opposite position. I went very long duration stocks. I think NVIDIA has certainly delivered probably one of the best quarterly returns in my 38 years investment career. And I think if you missed this run up in long duration stock, and you were hunkered down in utilities and you were hunkered down in healthcare, it's been a very painful quarter because those haven't done particularly well at all. So are the markets wrong? Are the markets overly optimistic in discounting this very much forecast recession? I think the commentators themselves may have been overly oriented towards sort of a herd instinct and linearly extrapolated what the fear factor was and the bearish factor. And I think the markets are more nuanced. So let me get stuck in. What's the headline focus? The headline focus is US inflation. If you have a look at the dark colored line, US inflation is proving to be a bit sticky. The small business pricing intentions index is an indication, one of many. You could use purchasing manager indices. There's a raft of correlated indices that show that inflation will fall in the months ahead. So you've got to sit back and think about things a little bit and say, well, you know, Powell might not be the sort of the most preeminent Fed chair in the history of chairs, but he's not doing a bad job. If you cast your mind back to a year ago, Powell really did have a loaded deck to deal with. The main concern that Powell had was the amount of money that had been pumped into the US economy from the start of COVID. So as a basic background, we all went into COVID at around this time in 2021. You can see on the chart, the lightly colored line was the amount of money that was pushed into the US economy by the Fed. And that's a huge amount. You've just got to get some perspective. If you look at the scale on the left-hand side, and I put some numbers to it, when we started off in 2021, the Fed's balance sheet was about 750 billion US, and there was about 50 trillion in notes and coins in circulation together with credit. 2 years later, the Fed had expanded the balance sheet to the point where money supply had grown by nearly 30%. That doesn't happen outside of war years. So the last time the money supply expanded so much was the 1945 era, which created very structural long-term inflation as post-war capacity got utilized. And so the Fed really had two things to deal with. It had too much money in the system, and real interest rates had moved into negative territory. Powell had to start moving to adjust both the amount of money in circulation, to use Donald Trump's much and overused term. He had to drain the swamp, but he also had to correct and normalize real interest rates. And I argued in the last webinar, is it a bull or a bear, that this was not a bear market. It didn't have the anatomy of a bear market. It didn't have the characteristics of a bear market. What we were seeing in June, July last year when we presented was that we were seeing a very dramatic backup in real rates. And if you have a look at the price earnings multiple contraction of the S&P, it's almost directly attributable to a backup in real rates from -1% to now 1.3. Now, if that wasn't difficult enough for Chairman Powell, you can add the demand side shock from COVID, the supply side shock from COVID, the supply side shock from the Ukrainian crisis. And I think his last 2 years have been pretty challenging, between drawing enough liquidity out so that inflation did not become structural, and the re-establishment of some level of normative real interest rates. That was a tough ask. I think even Volcker in his era would have had quite a mountain to climb. So I give Powell credit. I think under the circumstances, he has done a really good job of backing up liquidity and backing up real interest rates. And so if there's one takeaway from today, it's that the focus shouldn't be on inflation. The focus is on ensuring that inflation does not become structurally entrenched. And I think we're about there. So that does not concern me at all. What does the financial market say about all of this? We've experienced an incredible amount of, call it, policy volatility, where what you can see on the chart in front of you is the steps taken by Chairman Powell to raise interest rates. Yes, they have been fast. Yes, they have been sharp. But the market at some point didn't really know where to go. So all the dotted lines and the lightly colored lines are all what the forward curves were discounting at different points in their projection of the future Fed fund rate. Now, the issue around the pivot is important to address. The Fed would pivot if one of two things happened. There was a liquidity crisis, it may cut interest rates as well as supplying liquidity, or if the economy went into a growth slump, it would consider cutting interest rates in order to stimulate growth. The Fed has been very clear that it has separated its interest rate policy from its backstop liquidity support to the banks. And that's an important consideration when we deal in a slide or two with this thing called the Fed's conundrum. So I'm not placing a high level of emphasis on the Fed pivoting. I don't want US long bond rates to drop too much. If they drop too much, it suggests to me that the US economy is in trouble growth-wise, and that wouldn't be good for company earnings. So what we're seeing at the moment is we're seeing the market trying to come to grips where the balance is that the Fed will strike between re-establishing real rates, which it has, and managing the US economy in such a way that it takes structural inflation out of the mix, but interest rates aren't overly punitive for longer term growth. The market at the moment is saying with the big red arrow, Mr. Fed, you've done enough, back off, you don't need another 25 or 50 basis points. And so these forward curves are dropping, giving us an indication that the market believes that the Fed has done enough. So one of the issues to think about as you take the debate to the next level is this interesting thing called the Fed's conundrum. You go back to around 2006, 2007, you've obviously got the shape of the yield curve here. If the line is below the horizontal, then the Fed fund rate is higher than the long end of the curve, leading to this inverted yield curve. Now, the great prognostication at the start of the year was inverted yield curves automatically create recessionary environments and point to recession. Yes, they have in the past, but they do so because something happens within the economy that causes the economy to slow down. And typically, as I'll cover in a slide or two, the Fed raises interest rates to the point where it breaks something. So the importance of the Fed conundrum from a financial market perspective is takes us back to around 2006, 2007, and that's where the term was created. For anyone who's interested, I've listed the papers that are available on the St. Louis Fed. They're really well worth reading, and they're not light-hearted reading, but they're well worth reading because they take you into a world which shares how the Fed's conundrum works, and it goes something like this. As Greenspan was tightening and creating tighter monetary conditions, the bond market was creating easier monetary conditions because long-term yields were falling. And it sounds like a really weird concept to get into your head, but you've really got two worlds. The Fed is creating through its policy an environment which is much tighter, higher interest rates, more restrictive monetary conditions, but the bond market is creating easier financial conditions because it gets to a point where it says the Fed has done enough, and it actually starts to price in the risk of a negative event. So it starts to price in, as you saw on the previous chart, with the forward curves dropping down, some sort of easing up in future Fed fund policy. And that was colloquially referred to at the time as the Fed's conundrum. So my central point is that it is not an automatic consequence of a negative yield curve that you will have a recession. There are a couple of steps that happen between the recession and the inverted yield curve, which are quite important. One of them is housing. If interest rates in the short term get pushed too high, housing prices start to fall. And we've seen the number of months, what the chart shows is a couple of countries, Canada, Norway, Netherlands, United Kingdom, US, Germany, and New Zealand, where prices have peaked, the dotted line in the middle, and we're now 7, 8, 9, in some cases 10 months into falling prices. Falling asset prices aren't good for liquidity. Higher interest rates equals higher mortgages, and as a consequence, you get a softening in the secondary markets that the Fed can't control. Perhaps a little bit more troubling is the position of US regional banks. So you've got 3 lines on the chart, or 2 lines in the shaded area. The greenish colored line, small bank deposits. The purpley colored line, large bank deposits, and then the move into money market funds. So you can see that as we moved into tighter financial conditions by the Fed, depositors have become a little bit unsettled that there may be another 08-09 moment. SVB, Credit Suisse did not help. The steps taken by the Swiss Central Bank on Credit Suisse around Tier 1 capital did not help. Creates a lot of moral hazard where suddenly Tier 1 capital bondholders are not guaranteed of their bond holdings. And so what depositors have logically done is they've moved their money into money market funds away from banks. This creates the potential for a liquidity crunch within the banking system, even though Yellen has guaranteed deposits. If you look carefully at the wording of her statement, no one quite knows what deposits have been guaranteed. There's sort of this blanket assurance the Treasury will guarantee deposits. It can't obviously guarantee all deposits. So as a consequence, folk have started to protect their deposits. They've moved into money market funds. And why I'm positioned the way I am in global macro at the moment is I'm a little bit concerned that the second round effects still have to play themselves out. I'm not worried about inflation. I think the Fed has done a good job. I think they're a little preoccupied with inflation, so it might take the Fed, who's very data dependent, some time to accept that inflation is coming off. In that intervening period, in all the bear markets I've been through, I'm rather hardwired from a risk perspective to look at liquidity and volatility risk. And if we start to see a tightening up in liquidity risk, then equity prices could become a bit more sensitive to the downside. I don't see it from an earnings perspective, but I do see it from a liquidity and a volatility perspective. We're not seeing it at the moment, but what we are seeing is we're seeing quite a lot of stress building up in the system. So courtesy of a recent report by Alpine Macro, 2 charts to look at. The Fed always breaks something. Rate hikes in the early 90s, we can go through all the various crises. And of particular relevance is the chart on the right, the blue line. What has happened in terms of the separation of Fed policy, where you've got interest rates on the right and you've got liquidity, so interest rates on the left, liquidity on the right, is that the Fed is focused on maintaining that real interest rate environment. In the process of backstopping the financial institutions that are in trouble and creating sufficient liquidity for banks to be able to replace the deposits that have been withdrawn and shifted into money market funds, the Fed has had to open up a very big liquidity window. It has opened up all windows. Banks have to replace this capital in order to keep their lending books alive. You can see lending standards. I don't have the chart in the pack, but lending standards in the US have become very, very tight. And as the money gets withdrawn from bank deposits, the banks have to replace that through the discount window. And you can see that a significant amount of usage has already taken place through the discount window. Reverse repo market, discount window, they all add up. They're just different windows into the Fed. And oh, apologies, this one does show the tightening lending standards, is the dotted line in the discount window. So you've got a little bit of a sort of a three-way tightening up. The Fed has raised interest rates. It's likely to raise them again at the next meeting. Banks are short of capital. They've tightened up their lending standards. And the Fed is issuing significant amounts of liquidity through various mechanisms that it makes available to the market. We don't know how that's going to play out. It may all end reasonably well, but I'm mindful of liquidity and volatility risk as being a much greater risk than recessionary risk and an earnings bear market. Recessions and earnings bear markets happen because something happens in the system and it breaks. And that would be my core focus at the moment. Where do we go to on the dollar? I'm not sure I'm ready to write the dollar off yet. A lot of folk are calling for the end of the dollar bull market. I don't think we see a new bull market in the dollar, which is the black line. I think the US 2-year Treasury has given us an ample lead as to where the dollar is going. The ECB is going to have to stay firm on inflation. Europe is still quite in the grip of inflation. People's Bank of China is reflating. Bank of Japan is adding a lot of liquidity to the system, defending the yield curve. So there's quite a lot of liquidity being created by central banks, which gives me some comfort that we're not sitting with a 2008, 2009 type global financial crisis. But I think if the dollar were to go too strongly, or to appreciate too much, it would be a sign for me that I would need to go even more risk off, because rising dollar would indicate that the market is starting to hunt down dollars, risk off trade, no confidence in other currencies. So I'm happy with a weaker dollar. I don't think that's a bad sign at the moment. There's a lot of hope being pinned in terms of resurgence in China. So the argument goes something like this. Yes, Europe is in a little bit of a sort of a stasis period, but China's reflating. So we will see a pickup in growth from China towards the end of the year. The US may slow, but it's going to be counterbalanced by emerging markets in China. Again, I think one needs to be a bit cautious in just being overly optimistic that Asia or EM is the next trade. The chart shows you the most recent data from Chinese exports. The policy by Xi had hurt China. Yes, China is moving very strongly internally, and that demand pattern is looking a lot better. But I think with the US slowing, it's not going to be that easy for China just to get back to growth levels that it was in the past. The world has fundamentally shifted a little bit. So how are financial markets responding? So if we take that macro picture and we have a look at how it fits into financial markets, bear markets come in 3 phases. The first phase in the bear market typically lasts 9 to 12 months. It's a big reset on interest rates, PE multiples contract, and you typically have that very sharp drawdown. Something breaks, something resets, mostly systemic, structural, or interest rates. And those were typically the bear markets that we had in 1987, 61, 66, and the COVID shock. Bam. For the market to move into what I call a phase 2 bear, you need something else to happen. You need earnings to decline to a point where you have an earnings recession. How bad the earnings recession is dictates the extent of the phase 2 of the bear market. And then phase 3, which a lot of people were referencing last year, was have we seen the capitulation trade? We didn't get anywhere close to seeing a capitulation trade. I've been through markets where you can have 20% down in a month, and you have some stocks falling 40, 50%. So 2022, I think, was a very dramatic correction, not in an ongoing bull market, but a dramatic correction at the end of a bull market, driven by the backup in real interest rates. I think we are busy finding our way through this phase two, and it really depends on, over the next 4 to 6 months, whether the Fed hangs it together in terms of balancing its need to keep real interest rates and the Fed real interest rate where it is, versus the liquidity stresses that are starting to develop in the system. This chart may surprise you a little bit, I think, given our inherent feeling of the volatility we've all had to deal with. What we did over here was we went back in time and we said, how does the S&P perform around inflation peaks? And I know these numbers are always aggregate, so it really is nothing more than looking at the roadmap and trying to get some perspective. But I think the interesting takeout from the chart is once inflation peaks, which it clearly has, the S&P has kind of followed exactly the path that it would have followed in the path. And I think that surprises most people, because the mood in terms of the conversations that I have with a range of investors is much more uniformly bearish, waiting for the bear. It's just a question of time. The bear will come. And indeed, the bear has come in the past. There's the 08. I wasn't around for the 1957. I was around for the 1987. But I think the differentiator in my mind, having read up and studied these markets in the past, is that something structurally has to break before we raise the probability of going into a deep phase two type bear market. So that's not my base case at the moment. If anything, I see conditions being set up for markets to rise into 2024. Why is that? Inflation will fall. Interest rates have peaked. Forward curves are discounting lower interest rates. Lower interest rates equals higher PEs. Earnings base is not collapsing. Companies are cutting costs. They're trimming their income statement. That's good for profits. People's Bank of China is reflating. The BOJ is reflating. The Fed is reflating. We're back into a world where liquidity is opening up. The bond market is telling us financial conditions are getting easier. And the thing that's keeping us back from committing more capital to the market is the nervousness that something will break. Now, in order to try and find that break point, we follow a couple of interesting models. I know the graph itself in front of you looks a little bit weird, so I'll just explain it. What we do to try and work out what regime we're in is I have a look at the volatility. That's easy. I read that off the Bloomberg terminal. That's the VIX index. And the vertical axis is just simply the 2-year moving average of the difference between the 10 and the 2-year yield spread. So in very simple terms, without getting into technical jargon, if you're in the top right-hand quadrant, you're in recession. The Fed then stimulates, you go into a growth phase, and then you go into a contraction phase. We actually did not head off. And the reason why I was very long duration at the start of the year is that I did not see the possibility of us heading off into deep recessionary conditions. For that to have happened, we would have had to have moved right up into that sort of territory there. Yes, the volatility numbers were there, but no, we weren't moving in that direction. And that was why I made the call that we would probably move with increased liquidity by central banks to support these various issues that they were dealing with. And it all started with the Bank of Japan. If you go back to our previous presentation, I spent a lot of time talking about how the Bank of Japan was defending its yield curve. And in the last 3 or 4 months, they've pumped nearly $2 trillion in to defend that yield curve. And that's a lot of liquidity that found its way back into financial markets, a little like 08, 09 in the second quarter of 09, where the Fed started pumping liquidity back in. Risk assets did very well. It's sort of a paradox. Now, I think if you want to try and simplify it in your mind, what I'm doing today is sharing with you the macro environment, which are these four quadrants, and then the financial markets interpretation of the macro and the liquidity environment merged together. And the increase in liquidity by central banks in the first quarter of this year created quite rich conditions for long duration assets to do very well, particularly since they've been bombed out in December. What is the significance of this chart? What the significance is that if you go back in time and you have a look at how sectors perform, MSCI sectors in the different quadrants, it becomes quite a useful guideline. So going back to the Smarty Box charts that Anton was talking about, if you're in the contractionary phase, tech, real estate, consumer services, and discretionary do really poorly. Energy did very well in the last 2 years. Staples do a lot better, and obviously utilities and healthcare do very well. We were well positioned for that. But the call that I had to make was, were we going to go there or were we going to go here? There is a world of pain. Nothing does well in a deep recession. You don't want to be in energy. You don't want to be in financials. So if you cast your mind back to the Smarty Box chart, it is quite interesting that energy and financials are doing particularly poorly, along with real estate. And those are signals that we must not ignore, because they reflect the underlying concern around the macroeconomic environment. What's driven tech so strongly in the last while is purely liquidity. Liquidity by central banks, the easier financial conditions created by the bond market. Bond yields have fallen, PEs have gone up, and liquidity has supported that long duration argument. So if you have a look at the argument of, can equity markets rise in 2024? Yes, they can. They can, because inflation will fall, PE multiples will rise, but it's very contingent upon the liquidity environment and the systemic risk that is averted by central banks uniformly or combining to create sufficient liquidity so we do not have a break of something much more substantial than SVB. The earnings itself, a lot of very negative forecasts. I've seen many charts looking at PMIs and ISMs, and I'm not getting that sense from the bottom up. Earnings revisions versus the dollar, softer but not falling out of bed. And if you have a look at the EPS estimate revisions versus the S&P itself, and the rally that we've had recently, you can see that the dark line being earnings estimate revisions seemingly have bottomed and starting to look a little bit more positive. So I think if we put it all together from a positioning point of view, last slide in the pack, how have I been positioned? The short answer is very defensively. In global macro, we had a very, very, very nice run in the first quarter. Many of these stocks that you see under the tech base had done very well, 50% plus. I think NVIDIA was up about 94% at one stage. I have trimmed all of that back. I was long duration at the start of the year. I trimmed about 9 positions in mid-February. The markets have rewarded us again in March, so we've had a very good March. But you can see that the balance of the portfolio is very much around consumer discretionary, consumer staples, and technology. And that's where you would expect me to be if you go back to this chart on the bottom left-hand side, which is the correct read from the model at this point in time. The reason why I've got a very high amount of cash and very low exposure to energy and financials is I want to buffer against the potential for this quadrant to become more of a realized outcome. Not my base case, but that's where I'm using a type of barbell approach, 30% in cash, very underweight financials, very long tech, or less long. I was 6% at the start of the year, but long tech, long consumer staples, long consumer discretionary. Focus on quality, focus on companies that have got the ability to grow their earnings base. I see a lot of opportunity emerging in Asia, no pun intended. I see emerging markets as being part of the next leg of using some of the cash. And indeed, some stocks that I'd wished I'd owned more of, things like Hermes, LVMH doing very nicely, Eli Lilly on the pharmaceutical side, just absolutely shooting the lights out with their weight loss drug. A lot of good success stories in many of these companies. And part of the strategy that I followed is just to make sure that I didn't have any positions in the portfolio that were costing the portfolio performance, and balanced my exposure between the sectors that I was comfortable backing, given the arguments and the positioning that I've put forward today, and being very underweight financials. So Anton, that's kind of the framework behind macro at the moment. Thanks always to everybody who's invested in global macro. It's been a really phenomenal ride, and I'll mark the calendar on the 13th of May of this year, because that's our 10th anniversary since we started the journey. So thank you very much for your support, and happy to hand back to Anton.
Thanks very much, Tony. Yeah, some questions from any of you out there. Please unmute and go ahead.
Jared here. Tony, thank you for all of that detail. It's really interesting, and I appreciate your take. Just a question from our side on the idea that savings from COVID grants and also fixed rates on mortgages starting to roll off. It confirms maybe that your inflation, that you don't have to be as worried about inflation, but how does that affect the health of the consumer, and how does that play into markets pricing at the moment?
Yeah, it's a very important argument in the whole liquidity debate, because that excess money supply that I showed you is starting to contract quite materially, and a lot of folk have used a lot of those excess grants. So where do you get money from? If you've got a little bit of capacity on your mortgage bond, you can borrow up, and if the government's very nice to send you a check, you put that in the bank until you need it. So that is impacting the US consumer to some extent, but what gives me some comfort is that the jobs market is not unraveling. So yes, we've seen less jobs opening, we've seen less intention to hire, but I don't get a sense that folk is stressed either at the debt level or at the jobs level. When jobs start to go, folks start to pull back a lot more quickly than if they're just running down their savings with money that they never thought that they needed. So I don't see a really big pullback in a lot of the macro stats around consumer expenses, consumer discretionary expenditure. And I think the US consumers is doing relatively well in an economy which still has low nominal rates of interest. And yes, relative to where we've been, the rates have ticked up. But remember, in 1984, people talk a lot about Volcker. Volcker jacked short-term interest rates to 20%, and that was properly punishing. So the fact that you can refinance your mortgage bonds, at levels of around 4.5%, that's still going to be very affordable in an economy where inflation is going to drop, and you're going to have some reestablishment of the real earnings power. So the key is to look at the relationship, in my mind, between nominal and real. Nominal's gone up, real has contracted. Break-even inflation curve in the US is about 2% across the entire term structure. So I see a future where the decline, the disinflationary trends we're seeing at the moment at the consumer level, at the inventory level, a lot of inventory buildup that's being cleared with lower prices, lower energy prices, that puts power back in the hand of the consumer. And my sense is that they've got more than enough to tide themselves over. So it supports the argument that the recessionary environment isn't going to be dark and deep.
Any other questions?
Yes, thank you. Thanks, Tony. That was an awesome discussion this morning. It's Tatiana. I just wanted to ask, in terms of just leading on from that question, I think asked by Jared, it just seems a bit strange that the banks of all institutions that have got these regulations around them sort of miscalculated the rapid raise in interest rates and didn't almost do hedge or do asset liability matching properly. And then you think of the consumer who is not that astute as a bank would be. They would also, you would think that they would also, or could be, they would also probably abuse the low long-term interest, low long rates, and the same with businesses. And now I'm getting a shock with the funding. So despite all of the, you know, the relief given in COVID and the low, they've mismanaged. Isn't there a very big risk of all of that mismanagement in low interest rates environment coming through, sort of really hurting the consumer and hurting the businesses?
Interesting question. Let me unpack it for you in sort of two levels. The big banks have managed their duration risk rather well. So JP Morgan, for example, has very little duration risk on their book. If you look at the books of SVB, I think it's fair to say that the guys probably just were at the height of incompetence on the Treasury desk. I take you back to our own example with something like African Bank. You've got two components of a bank. You've got hold to maturity and you've got available for sale. And the idea behind it is that when you structure your loan book, you match your assets so that you can hold your assets to maturity, and there's no duration mismatch. And that's what people like JP Morgan have done very well. The problem with SVB is that they had very little hold to maturity. All of it was available for sale, which gets marked to market. Now, the Fed's very well aware of this. The Fed has indicated that in times of stress, it won't force the banks to entirely liquidate their available for market at current market yields. It would buy them over on their maturity value, very similar to what they did in the first part of the global financial crisis. So I think the GFC has really created quite a heightened level of awareness from the central bank perspective as to what needs to be done, as opposed to the days you may recall back in 2008. It was Paulson and I think Bernanke that went to Congress to ask for 750 billion QE1 to bail out AIG, if my memory serves me correctly. And the moral hazard and the hazard in those days was much greater because everyone was arguing, well, oh, this is moral hazard, you know, too big to fail. And as I showed you, the Fed ultimately ended up pumping in many trillions of dollars into the US economy, somewhere around about $9 trillion in total. So I think the mechanisms these days to cover banks is far more liquid. SVB got consumed in a weekend. You know, do I think that SVB is like Barings and we're just waiting for Lehman's? That would be a difficult thing to argue because I think the bigger banks structurally are a lot more solid. I think Credit Suisse was a particular case in point. It got gobbled up. It's going to be restructured, you know, just had some bad mismanagement. So I'm not picking up that level of stress. I think what worries me a lot more is that the regional bank index that you can pick up on Bloomberg, the ETF, down about 18%. And I think what that's suggesting is that the collateral risk to banks lies more in the secondary market. So small banks lend to small businesses. Small banks lend to households. And with capital being withdrawn from those small banks and them having to replace that capital at a much higher rate than what they would be paying depositors through the Fed discount windows, that creates an environment for potentially a perfect storm where the liquidity in the regional market will tighten up much more quickly because banks just don't have the capital to lend. So I'm not that worried about the duration mismatch. I'm worried much more about the liquidity mismatch. Regional banks who lend to small businesses and lend to households just aren't going to be lending. And that's going to create potentially second order effects in those markets. If you're in a small business and you're in Iowa and you go to your regional bank and you fund your next sort of crop seeding with loan finance, does the bank have the capacity to lend? I think that's where we've got to be very, very vigilant, because it's that second order effect that starts to create the liquidity crunch. And a lot of the bear markets I've been through have been driven by just one thing, liquidity driven event. It's very difficult to predict where it comes from, but when it comes, it tends to be, a little bit structural and a little bit like rolling thunder. And it's very hard for the Fed to intervene there because they can only supply liquidity at the rates that they set. And they've set very high rates. When a significant portion of global macro is invested in the ultra short-term JP Morgan US bond fund, which is yielding about 4.75%. And I think that's where your big issue lies, is that the Fed is going to be so sticky on inflation, it's going to keep rates high, and that funding window, it doesn't matter how much they supply, the interest rate is going to be very, very tough for the lender to bear.
Thank you so much.
Tips, back to you.
Yeah, time for another question.
I hope you're a lot more upbeat than most of the investors that I speak to, but I think the key here is, have one focus on opportunity, which I think is abundant, but don't lose sight of the risks. And that's what we're very privileged to be able to do in global macro. Being flexible is being able to manage both sides of that equation. So I think it's a very nice fund to have the privilege to run in these sort of markets.
There was another question I heard coming through.
That's Jared here. I just wanted to ask maybe just Tony's opinion that inflation target is 2% in the US and it's currently at what, 6 or 7? And it doesn't look like it's letting up as aggressively as potentially the Fed would want. Does that not create the liquidity drain if they have to keep rates higher? I mean, I think that seems to be a bit of your base case.
Spot on.
But
absolutely spot on. So
does that create
the Fed is in this sort of spot on. Yeah, spot on. The Fed's creating a little bit of a headache for itself, because on the one hand, it's got to keep rates up to do exactly that. On the other hand, it's got to provide liquidity backstop. And, it's a little odd, right, to do both at the same time, because the one is tighter financial conditions, the other one is creating easier liquidity conditions. At the end of the day, the tighter financial conditions will filter through into the market over an extended period of time, and it will make the Fed's job much harder to deal with a true liquidity event when it comes, because the backdrop is structurally higher interest rates for longer. Absolutely.
But does that not then argue against the duration positions?
Oh, from my perspective in the fund, that's why I said I've already taken a lot of duration risk off the table. Sorry, just to make that clear, we sold 9 stocks quite materially down in late, I think it was around the 14th of Feb. So I trimmed everything from NVIDIA. I sold Lam Research. I sold out of half Palo Alto, Fortinet, Adobe. Everything in the portfolio that's long duration, we significantly trimmed in mid-February. Fortunately, the market came back in March and just gave us a boost. But I'm not going long duration in the portfolio. My focus is to maintain quite a low duration, specifically for that reason.
Perfect, thank you.
Or put slightly differently, I think the best of the duration trade is behind us.
Got it. Thanks, Tony.
Thanks very much, everyone. I think we'll sort of conclude there, perhaps just leaving you with one thought, and that is how you want to position your clients' portfolios over the next 12 months. And I suppose some of those questions are, do you want to bet on the 2024 election? Do you want to bet on an EFF ANC rally or rally ANC EFF coalition? I suppose the one option is to go global. And as Tony has highlighted, there are all sorts of opportunities and threats there. So do you want to buy a growth manager? Do you want to buy a value manager? We've seen what happens when financials go against you. I think the answer is that flexibility is key in the next 12 months. So thank you to everyone. And we will do one of these. I think we're going to have to do them more regularly in the next while, as things change considerably over a very short period of time. So thank you very much, and thank you to all for your support. And we look forward to seeing you in the Dollar Fund as well. Thanks, Tony. Thank you to everyone.
Pleasure. Bye now.